I'm happy to say that Carlos Mendez is back. He is back on the street and back with us here on Bloomberg. He left investment bank ICP and is now the new head of structured finance at Sandler O'Neill to put financing together for troubled banks. But he does remain a favorite source on the swaps markets, where trading reflects growing concerns over several companies. But these days, it's really over BP. And Carlos, welcome back.
Good morning.
Good to see you.
Good
I know you just joined a few days ago, right?
I did. I was in London when they announced it. I'm very happy with the ability to join the bank.
Great. Okay. Well, we're glad to have you back. Let's take BP first,
yes,
because we've been hearing so much about what's going on in the swaps market with them. A 40% chance of bankruptcy. What's going on?
Well, I think when you look at the 40% and you correlate that directly to the actual percentage of bankruptcy, I think it's a misnomer or a kind of a misdirection really on what's happening on the trading side.
Okay.
If you look at the pricing from the 1 year to the 5 year, they're inverted. In other words, the 1 year is pricier than the 5 year. So you ask yourself, why is that, right? And you've seen this time and time again in fallen angels in the marketplace. These are credits that were highly rated, then dropping very, very quickly and precipitously to either triple B or non-investment grade, which is the case here with the Fitch rating going from AA to triple B. But what does that cause? You have pension funds and money market funds and such who own these bonds, and suddenly they are not only do they have to sell, they're forced sellers. And some who don't want to sell all their holdings then go out and take some hedging, but they want to feel it out. They want to the understanding of what the liability actually is to the company.
Right.
So they instead go ahead and take out a swap for a year.
Okay.
That starts to then eat up the supply and raise the price. And the other function is on the dealer side. So as the dealers start to get long these credits, they start to then protect themselves in what's called a jump to default scenario, so that they can end the day flat. So they themselves start to buy the 1 year.
So they're starting to hedge then.
Exactly. So it's a technical, and you start to see the price just rise and rise and rise. On the technicals, everybody tries to balance their books, but this doesn't necessarily reflect the risk of bankruptcy to the company.
Well, then how much does reflect the risk of bankruptcy? Is it hard to say?
Well, I think that's where you're a speculator, and I think a lot of folks I think it's easier to reflect some of the direct damages that that the oil spill is having, not necessarily on the company. As you can see from the actions this morning, I think they're trying to ring fence the losses, but some of the knock-on effects into some of the property. And Sandler O'Neill has an analyst working directly on the effects of the banks inside the Gulf region. I'm sure municipal desks are working on the effect of municipal bonds to the oil spill, and those are more direct. But I think it's very hard to figure out exactly the ultimate damage.
How much does this, all this trading on their swaps, how much does this actually affect BP though itself, or does it?
Well, it's too early to tell. The rating, S&P is still behind on, well, maybe not behind, but they believe the company is still a AA company. So there's a lot of things moving very, very, very quickly. The $20 billion number, is that enough? Is it going to be more? I think those are all the questions that they're going to, and then they cut the dividend as well, which was a big boost to the swaps. So you saw swaps come through 600, and then, or they were above 600, and now they're through 500.
Right.
You saw their cash bonds, which were below 90, rally to 95 on that news. And you're going to see the rebalancing and the recalculation of the coverage on bonds as all this plays out. Okay,
so moving on from BP, though, to the other oil companies and their CDSs, then, do they get affected by this?
Well, you're starting to see some production numbers. I think you had an analyst earlier on from Deutsche Bank who started to say, hey, these are some of the effects that it's going to have. I think
when the rigs move,
yeah, and when you look at history is a good place to look. When back in the late '60s, when they had the oil spill in Southern California with Santa Barbara, and that created the Environmental Protection Agency, and that
which we forget. Thanks for reminding us.
Yeah, we've been here before. We had gloms of oil on the coast of Santa Barbara. And people got really upset. We initiated Earth Day off that. Hopefully, we have some positive things like that come out of this mess. But the that really is trying to calculate what is the cost of doing business, the decrease in production over the short term, which is going to affect all companies in those regions. And I think that analyst from DB was starting to kind of play that out. So I think that's where it's going to come out.
He was pretty spot on that.
Yes. Yeah.